Hello and welcome to the Tax Roundup for July. And a quick shout out to all those guys who came to the Knowledge Exchange Conference. I hope you've recovered. Inside this month, we're going to take a look at a Main Residence Exemption safe harbour in a new PCG. Now that deals with inherited property. We're also going to take a look at, once again, Main Residence Exemption, a really interesting case that's come out looking at a property that was held in trust and a taxpayer attempting to apply the Main Residence Exemption. But first up, some important update on the single touch payroll and how it relates to closely held payees. Across to you, Michael.
Now, we need to talk about single touch payroll because from 1 July 2019, that system basically applies to every single employer. So with businesses that have 19 or fewer employees who haven't had to report using single touch payroll as yet, from 1 July 2019, that all changes and single touch payroll becomes a reality for all of those businesses. Now, leaving aside the what and how of single touch payroll, the ATO has recognise that there's some practical difficulties, particularly for very small businesses when it comes to adopting and moving into the single touch payroll framework. And I just wanted to touch on a couple of those things as people start to get their heads around moving into that for their smaller businesses. So the first thing is around closely held payees. And one of the practical concerns that we had raised some time ago was when you have people who are, say, directors of their own companies, they might be a working beneficiary of a trust, there's a real practical issue around sometimes they don't know exactly what their salary or wages are for the year until a little bit after the end of the year. So finalising that data, sending it through single touch payroll in real time, there is just a practical problem with that. Now, it's something that we'll probably all need to get our heads around at some point over the next couple of years, but the ATO has provided a bit of a transition period to kind of get that right over the next couple of years. For the 2020 income year, which will be the first year of single touch payroll reporting for those smaller businesses, so for 19 or fewer employees, the ATO has basically said you do not need to report closely held payee payment information through single touch payroll. You will still need to report, but basically reporting as you would at the moment. So issuing payment summaries after the end of the year rather than reporting it electronically through single touch payroll. So for the 2020 income year, this 1 year period, payments to closely held payees don't need to be reported through single touch payroll for those smaller employers. Payments made to other employees, arm's length employees, so non-family members, non-directors, non-beneficiaries, those will need to be reported through single touch payroll. So it's not that those businesses are exempt from single touch payroll, it's only payments made to closely held payees, the directors, the working beneficiaries, the family members. Now for the 2021 year, the ATO is saying, look, we now expect from that point onwards that payments to closely held payees will be reported through single touch payroll, but the ATO said that they'll allow that to happen on a quarterly basis for that year. I assume that from 2022 year onwards, it will then become full single touch payroll. But for the 2021 year, a quarterly option is available. It's optional, you don't have to use it, but if you want to, the ATO says that is available. Again, that's only for closely held payees. And the ATO basically says you need to come up with a reasonable estimate of what the salary and wages are for that quarter. And the ATO at this stage is giving us three kind of options in terms of coming up with that reasonable estimate, potentially looking at last year's figures and using that as a proxy for what this year might look like, and then tidy that up as the end of the year happens. But that's for the 2021 year. So we'll worry about that more as that time comes closer, and hopefully by that stage we'll have a little bit more in terms of the ATO fleshing out the practicalities of how we would do that. But for the 2020 year, don't need to report closely held payee payment information through single touch payroll. Now the other thing is that the ATO has said that where you are a micro business basically, you could potentially use your tax agent or BAS agent to lodge the single touch payroll data on your behalf. Now there has been a lot of confusion in terms of what that really looks like. The ATO has made it really clear that you can't lodge that information through, say, the ATO portals. You can't lodge it, you can't give it in as part of your business activity statement process. It has to be done through single touch payroll enabled software. So the ATO is simply saying that rather than the business having their own single touch payroll software and reporting as payments are made, they will allow, again for a transitional period, for micro employers to basically engage an agent to lodge that information to the ATO on their behalf. But it has to be done through single touch payroll software. So the agent would be running the software. They would have a separate category set up for that particular business, and they'll report it in that way. So just to make it clear, you can't lodge the information through an ATO portal. That won't comply with the single touch payroll obligations. So for a lot of people, the reality of single touch payroll is starting to set in terms of practically speaking, how do we do this? The ATO has some concessions. It's well worth taking a closer look at those where you or your clients are affected, where you're a smaller employer, because we'll have a year or two by the sounds of it to kind of get used to using that system. But we can expect from 2021, 2022 year onwards, at this stage it looks like the expectation is that those businesses will be fully in the single touch payroll system.
Now onto that safe harbour concession when selling inherited property.
Now, a little while back, the ATO issued a draft PCG indicating that there would be a safe harbour concession offered in situations where an estate or a beneficiary is selling an inherited property. And where this all comes from is that within the Main Residence Exemption provisions, in some cases, when you sell an inherited property, you can qualify for a full exemption if certain conditions are met. What you're typically looking at, first of all, is are we dealing with a property that was owned or acquired pre-CGT by the deceased individual, and that is a dwelling? Or is it a dwelling that was the deceased individual's main residence just before they died? Now, if either of those two categories apply, then the sale of that property by the estate or beneficiaries can potentially be CGT free if the property is sold within 2 years of the date of death. If it's sold outside that 2-year period, there's two options. One, we might be able to show that that property has been used as the main residence by certain qualifying individuals. But if that hasn't been the case, the only other real option to get that full exemption is to ask the Commissioner to extend the 2-year time period. So the legislation gives the Commissioner the discretion to extend that time period in appropriate circumstances. And previously, what people would have to do is once they're outside that 2-year window, they would have to basically apply to the Commissioner through a private ruling, setting out the circumstances and hoping that the Commissioner would accept that it's reasonable to extend that time period. Now, what this final PCG basically says is that the ATO will basically give you an additional 18 months on top of that first 2-year period as the extended time period for selling the property after the date of death. But there are a number of conditions that need to be satisfied in order to qualify for that. If you meet the conditions and the property is sold within basically 36 months of the date of death, then you don't have to actually ask the Commissioner for his discretion on this issue. You can basically just assume that that discretion has been granted. What you're then really focusing on is making sure that you have sufficient evidence to show that you've met the conditions set out in the PCG. So you need to show that there's been some delay in being able to sell the property. Might be a challenge to the will, it might be a complex estate, and there's been some work that's had to be done to figure out exactly where assets will pass through to beneficiaries. So the PCG sets out some of those circumstances which basically you need to fall within one of those categories to qualify for this automatic extension. There are also some time period requirements as well in terms of how soon the property is sold after it's been listed for sale and how soon the property is listed for sale once some of those issues have been sorted out. So there are some conditions that need to be satisfied. We will need to work through the detail of the PCG, but important to note that just because a property is sold more than 2 years after the date of death, you don't necessarily have to go to the ATO and ask for an extension. You could potentially qualify for an 18-month extension on top of that initial 2-year period if some of those conditions can be satisfied.
Now the case that looks at proving ownership of trust assets, Mingos versus the Commissioner of Taxation.
Now, in terms of cases this month, we're going to have a look at the Mingos case, which was a federal court decision looking at the application of the Main Residence Exemption. The dispute in this case wasn't so much around the technical aspects of the Main Residence Exemption. The dispute was really over who owned the property. Now, the background facts are a bit complicated, but broadly what had happened was, as a result of a family law dispute, a family court order had resulted in a property with a dwelling being transferred to the taxpayer. What seemed to have happened though after that was that the taxpayer took steps to basically have that property held in trust. So the legal title to this property was held by the trustee of a trust. Now, the property was sold later on. This particular taxpayer had actually lived in the property as their main residence. They believed that they should qualify for the main residence exemption. The Commissioner didn't agree. The Commissioner's view was the main residence exemption can generally only apply when that dwelling has been sold by an individual and it's that individual who has used the property as their main residence. The exemption can't normally apply when a property is sold by a trust or by a company. So the exemption can normally only apply when the property is held by an individual. Now, there are a couple of exceptions to that. There is a specific exception that applies when a property is held by a special disability trust and where the person with a disability, who's the primary beneficiary of that trust, has been using the property as their main residence. That wasn't relevant in this case. The other exception is that the ATO has indicated for a while now that if you can show that the individual who's been living in the property is absolutely entitled to that property as against the trustee, then they are essentially treated as the owner for CGT purposes, even though legal title might be held by the trustee. That's the argument that the taxpayer was running in this case. The taxpayer said, well, yes, this property is held in trust, but it's held by the trustee in a different capacity to the other assets that were held in the trust arrangement. So they're saying that this particular property, yes, it was held under a trust arrangement, but it was more like a bare trust arrangement. And the taxpayer argued that they were absolutely entitled to this property as against the trustee. Therefore, they were the real owner from a CGT point of view and should therefore qualify for the main residence exemption. Now, ultimately, the taxpayer was unsuccessful. The court said the main residence exemption is not available in this case. The court wasn't convinced that the property really was owned by the taxpayer. It wasn't convinced that they were absolutely entitled to the property as against the trustee. And there's a few things that worked against the taxpayer in this case. First thing was the court looked at the accounting records, the financial statements for the trust. And on the financial statements, this property was listed as an asset of the trust. The taxpayer had signed the accounts every year, so therefore indicating their belief or their understanding that this was actually a trust asset or trust property. So that certainly didn't help. The accounting records that have been put in place over the years indicated that the property was really held by a trust. One of the other things that worked against them was when the property was sold, a resolution was passed to basically distribute the gain from the sale of the property to the taxpayer. Now, that's not consistent with the concept that the property belonged to the taxpayer. If it really belonged to them, why would you need to distribute the profit from the sale from the trust to them? It would probably have belonged to them in the first place. So some key evidence really worked against the taxpayer's argument that they were the real owner of the property. Now, it's not uncommon for this sort of situation to arise in practice. Some people will have their family home held in a company or a trust structure for various reasons. And sometimes a lot of time passes and maybe the reason why it was put into that structure has kind of been forgotten about. Clients will often try and argue, well, it's really my property, I own it, I live in it, I might pay the expenses relating to the property. This case demonstrates that isn't necessarily enough. That needs to be supported by evidence, and particularly in situations where it appears that the property is held in trust, genuinely held by a trust or a company, and later on someone's trying to argue that they have become the owner. Well, the risk there is that there is some other CGT event, possibly other tax implications, duty implications that could have been triggered if you're really trying to make that argument. So we need to be very careful about how things are owned and what evidence is in place to support or not support the argument that our clients are taking.
And that's the tax roundup for this month. Parliament sits again in early July. Keep an eye on Knowledge Shop's Twitter stream. We'll keep you up to date with the legislation as it comes through, including the proposed changes to the income tax rates. We'll look out for that one. If you're a member of Knowledge Shop, then of course, as we move into the new financial year, keep an eye on the standards and the work papers we have available. We'll keep those, we'll bring those updated ones to you. If you're not a member of Knowledge Shop as yet, then give the team a call on 1800 800 232 and let us show you how we're making the lives of accountants and advisors so much easier. Speak to you soon.